It is around this idea of the industrial renaissance, about which you hear a lot. And I want to go out on a limb and say this is very possible. It truly is.
Our retail delinquency last month was the first month that we have seen a significant dip in our non-credit retail being more delinquent paying the rent.
It's an exciting time because uncertainty should lead to more of a return for operations and less capital allocation. So that's good for a platform like ours.
REZA Insights provides timely content from the real estate industry's preeminent thought leaders with insightful and thought-provoking strategies, best practices, and intelligence covering the relevant topics of the day to help inform our clients and the broader real estate community. REZA Insights is brought to you by REZA Investment Group and is moderated by Reza Etadali, CEO and founder of REZA Investment Group. Today's discussion includes a diverse panel of industry experts.
Hello, everyone. This is Ramez with REZA Investment Group, and thank you for joining us for today's webinar discussing global capital market volatility, trade wars, migration, and climate change. Our panel will be exploring how escalating trade tensions, global migration shifts, and climate trends are influencing the retail capital markets and real estate capital markets, and how investors can best navigate this evolving landscape. As a reminder, all participant lines are currently muted. We're honored to be joined by our keynote speaker, Dr. Parag Khanna, CEO of AlphaGeo, a leading firm specializing in AI-powered predictive analytics focused on climate change and human migration. Dr. Khanna is a renowned global strategy advisor and the internationally best-selling author of 7 books, including one endorsed by Berkshire Hathaway's Charlie Munger. His commentary is regularly featured on global media platforms such as CNN, BBC, CNBC, Bloomberg, and Al Jazeera. He holds a PhD in international relations from London School of Economics and both bachelor's and master's degrees from Georgetown University's School on Foreign Service. In addition, we're pleased to welcome a group of esteemed industry leaders as guest panelists. We have Alex Nyhan, Chief Executive Officer of First Washington Realty, Sandy Sigal, President and CEO of Newmark Merrill Companies, Nick Wibbenmeyer, West Region President and Chief Investment Officer of Regency Centers. And in light of the current administration's recent escalation of tariff-related policies, we've also invited Jonathan Woloshin, Head Real Estate and Logic Analyst with UBS Chief Investment Office Americas, to offer additional macroeconomic perspective. We'd like to extend our sincere thanks to each of you for sharing your time today. And with that, I'll turn it over to our CEO, Reza Etadali, to kick off today's discussion. Thank you again for joining us. We hope to find the conversation both insightful and valuable. Reza?
Thanks, Ramez, and hi, everyone. Originally this discussion was going to be primarily about climate impact, global migration issues that would impact U.S. capital flows, and especially tied into the LA fires and the impact on insurance companies. We will touch a little bit on that, but given all the volatility in the market and what's happening with the global tariff wars, we thought we focus more on that. And fortunately, Parag is an expert in this field as well. Parag and I are friends for a number of years. We were at Berkshire Hathaway meeting several years ago where he gave a keynote talk for the value investing group. And so I've asked Parag to really kindly focus primarily on what's happening currently in the market and give us some clarity about what to expect and what may be ahead for us. None of us know what's happening or going to happen 100%, but we can create some probabilities of where it's coming, and Parag is going to help us with that. So Parag, thanks so much. I know you're super busy. Parag is up late in Singapore and doing this call at almost midnight for us. And thanks so much. I know last night, our time when I talked to you, you had a crew of Swiss journalists at your house, and now
Still awake.
So thanks, Parag, and please go ahead and give us your thoughts.
Pleasure. Thank you so much, Reza, Ramez. Delighted to join you all again. How can one sleep, quite frankly, at a time like this, right? Things are just getting warmed up on the East Coast. So it's whether it's Twitter or some other social media platform, over here in Asia, we have our eyes glued to the unfolding realities. I'm so thrilled to be joining you all and can't wait to hear the other panelists' commentaries as well and to have a rich discussion. So let me make a few comments to kick off before I share some slides as well. But as Reza mentioned, this is fairly timely because my own background is in geopolitics and geoeconomics. 20 years ago, I wrote my first book about how China, the European Union, and the US were either frenemies or something more hostile than that. And here we are in 2025, and in Europe, they're talking about a divorce from the United States. And needless to say, the US and China are not friends. So the triangular relationship among these three centers of geopolitical power, United States, Europe, and China/Asia, has been just central to my entire academic and intellectual upbringing and focus for pretty much my entire life. So we're living in that world now, and therefore it's important to realize that some of the realizations that people are making right now about can we decouple, can we not decouple, what does decoupling in trade versus in finance look like, what kind of transition might there be in the global monetary system in terms of the reserve currency. A lot of these things that are playing out, and again, that people are waking up to today, have actually been in the process of unfolding, right, for quite some time. And some of us have been obsessed with exactly those issues for the period of time. And so you would need to dig back, into people's specific predictions and whatnot. But if we just fast forward to the present, it's actually pretty clear that China, has been preparing itself, right, for a situation like this. Someone put on social media earlier today clips from an 8-year-old debate that I and Ian Bremmer and others did in New York about the first trade war, about what the debate was, the U.S.-China trade war. And we were live in front of an audience in New York City. And so here we are again. So let's not forget that China has been paying attention and preparing for scenarios like this in order to insulate itself. Now let's bring it to the impact on the home front and how all of this is playing out. I think of all of the distressing signs and data points that we're getting exposed to on a daily basis. The most worrying would probably have to be the disjuncture between the 10-year yield interest rate and the dollar getting weaker, right? Because those two things have tended to move in tandem, and now they have split. So what does that mean? Well, it means that the dollar is no longer viewed as a safe haven on the one hand, and it also means that Trump's fundamental objective, or at least the Federal Reserve's fundamental, or the Treasury Secretary's fundamental objective of reducing refinancing costs on the debt, are not going to get accomplished in the way that they set out to do, right? So that's just one of the severe conditions. That only compounds the, sort of the forecast around a recessionary environment that was already being made, in earlier in Q1. Now, at this point, those obviously being lagging indicators, all sentiment, is pointing towards a recession or something much, much worse, more like a stagflation, perhaps even worse than that. Right now, we're getting data every minute around new home financing, loan applications getting rejected, auto loans getting rejected, all of these kinds of more high frequency indicators that are obviously flashing red across the board. So again, we all have our laundry list and menu of sort of bad news, if you will. I want to transition into looking at the US domestic picture and how it translates into actual real estate. But the macro point that I want to leave you with is just to reinforce the first one. We are moving towards a scenario that I call continental drift. And it's one that I started writing about well over a decade ago, more or less after the GFC. I said, you're going to kind of have a North Americanization, a Europeanization, and an Asianization. And each of the three areas is going to strive to be somewhat more self-sufficient than they were before. Whether or not they achieve that at the expense of others and to what extent there are still, globalized ties between them, whether it's in capital markets or trade or FDI, that will vary. But each is going to pursue some greater degree of self-sufficiency than they had before. And now we're moving in that direction, at least the attempt at that direction. So therefore, what we see happening in the US is going to be a fundamentally unique analysis versus what we're seeing in other parts of the world. So stagflationary risk, I'll move a little bit more quickly now. But of course, now we've had interest rates jump. I'll revise all these numbers, every week probably. Inflation, latest data showing it stabilizing, but again, we're going to have to revisit that in light, obviously, of the continued tariffs on China, obviously, and the impact that has. Now, of course, we can go into some more detail around the exceptions that are being made for certain categories, which are, some of them are like China-size holes in the tariffs that are meant to apply to China. But leaving that aside, obviously, we can fully expect the tariff picture in general to have this inflationary impact. We're seeing the impact on consumer sentiment. What kinds of impact at a big picture level? And again, I'm going to have to revise all of this. Do measures such as tariffs tend to have, or what are the economic expectations around the current picture? Again, I made this maybe like 2 weeks ago or around then, but you're going to potentially have a decline in our GDP growth forecast. You're going to have, again, inflationary spikes, energy costs going up, unless, of course, there's a genuine contraction in economic activity where you don't necessarily experience that energy price spike. Unemployment could obviously go up. CapEx is being stalled. The S&P correction, could sort of sustain or drop further. And then the yield profile is going to be gyrating as it is right now. What does this mean in terms of, sort of obviously the interest rate remaining high as it has, though, of course, now there's talk about just the severe pressure on the economy despite or maybe because inflation appears to have been brought under control, at least in the most recent data. Maybe there's going to be sort of a very strong political pressure on the Fed to lower interest rates. We'll see where that goes. Now let's look at the role of real estate here. So when you have a stagflationary environment such as this, obviously some asset classes perform better than others, or at least are able to retain value. So I'm highlighting here, the high growth office submarkets, this kind of flight to safety argument, the areas that are already relatively high growth. Obviously, the rental market in terms of multifamily, and of course, just the kind of essential services kinds of properties. Those kinds of areas, are those that retain value in times like this. I'll pivot now over to the demographics. One of the factors that really is going to compound, I think, the pain is of obviously the population plateau. So we have our domestic indigenous, call it population plateau, as a result of low fertility. Then you have to take into account everything from lower in-migration as a result of the border being shut, and even deportations and so forth. So, flatlining population growth is obviously not a good thing when you're trying to generate economic growth. Let's remember that under the Biden administration, population growth was, of course, a key driver of the economic rebound post-COVID. So now we're kind of flat in that area, and really no one knows where the picture is, right? Howard Lutnick can sell 1,000, sort of gold cards, as he's calling them. And I think he's just announced the first 1,000 have been sold, netting $5 billion, allegedly. Allegedly, I want to really see I want to see the bank statement there. But the rank and file migration is obviously slowing down tremendously. Let me make a quick caveat, a sidebar point around tourism and hotel occupancy or holiday rentals. If you see the data around Europeans canceling their holidays and everyone else canceling their holidays, that's obviously hugely problematic as well. And you think about students who may not be coming, I can directly cite cases of students who aren't going to leave the country for a while because they're worried about whether they can come back. On the other hand, you'll have people either leaving and not coming back, or obviously people not coming at all. So a huge drop off in tourism as we head into summer is not the kind of thing you want to have, obviously, in various asset classes in the real estate market. So, we're going to have slower household growth. This is going to be another economic contraction, which quite frankly could be another micro baby bust. The GFC was a baby bust. COVID was a baby bust. I wouldn't put it out of the realm of possibility that this is going to be yet another one, because economic hardship obviously decreases fertility substantially. So we have, a great challenge there, and we have insufficient housing stock at the moment, but who knows what people can actually even afford if we do decide to continue to, or if the Trump administration has talked about deregulating, cutting red tape, and really promoting an expansion of supply. But I worry to what extent that's going to happen and where it's going to happen and the timeline in which it's going to happen versus our demographics in the country without migration. So just quickly, I cite the green card here, or the gold card here. Again, only if you were to have really a steady influx in migration as we've had over the past several years, post-COVID, would you see a sustained impact on property values in specific markets. We actually look at immigration. We look at domestic migration. We also look at international immigration and which cities are favored by which immigrant communities. There's going to obviously be a kind of a reset in all of that for a while. So, a little bit more on demographics. I mentioned the declining birth rate, the aging population, the financial stress faced by American youth. What does that mean in terms of the kind of real estate product that we should be building is what I want to get into. Well, of course, multifamily is crucial. You've had a general decline in the percentage of the population that are homeowners. You've got most states actually building more multifamily than before as a reflection of that trend. Again, smaller family sizes, no appetite to own, inability to afford it, more likely to simply rent. Getting back to this point around building housing stock, this is so speculative at this point. You've heard about freedom cities. Again, cutting red tape. Some AEI calls it a new homesteading act, building 1.5 million new homes on federal land near major cities, building 20 new cities, holding competitions for those cities. I don't see a huge appetite, right, for any of this right now, other than in PowerPoint presentations. So, TBD. Do we need to do it? Yes. But is it being done in the right places? And what's the economic model around these locations? That really hasn't been thought through. But could we map out the locations where the Department of Interior and the Bureau of Land Management within that has the largest stock of federal land that could be released near areas where there is housing demand, where there are shortages, where you have some steady indication of demand like population growth? Yes. And by correlating that, you could get a good sense of which locations you would want to be adjacent to. In terms of product, I think that what America needs more of is kind of walkable, mixed-use, multi-generational communities. This is crucial. Elderly people, struggle to drive. They prefer walking. You want to have amenities. You want to have medical facilities. You want it to be multi-generational because we have an immigration problem, obviously. We don't have childcare for everyone, and domestic help and so forth. So the physical solution is embodied in the kind of mixed-use, multi-gen, walkable kind of master plan, of which there are exceedingly few, right, in America, right? How many actual properties can you even name that are affordable that meet these basic criteria? And the answer is not nearly enough. So we're going to have to do some pretty large scale retrofitting, in high demand areas. So we correlate this to, geographies of economic momentum as well. Let me jump ahead to, key part of the picture, and I want to try to steer us in a slightly constructive, maybe even optimistic direction. Okay, I'll say constructive, but not optimistic at this point. But it is around this idea of the industrial renaissance, about which you hear a lot. And I want to go out on a limb and say this is very possible. It truly is. When people say that, oh, reindustrialization is going to take decades, they're obviously envisioning in their mind the kind of old school factories, the likes of which are not what we would actually be building, right? A Tesla gigafactory is not some kind of, Vietnam 1970s shoe manufacturing plant, right? America can do pretty high tech, even automated manufacturing. And these are the categories where, whether it's the nearshoring or the new domestic investment, has already shown signs of taking off, and our mapping of exactly where these are. Every 2 weeks, you can actually generate a fresh data set of new corporate greenfield investment. So when NVIDIA says they're going to do more with chips and Apple says it's going to nearshore this and that, you can capture that and keep on putting it down on the map and seeing which locations, therefore, are going to have the all-important multiplier effect that's going to bring in, that's going to lead to higher demand. So, we map out technology, clean energy, automotive, healthcare, basic materials on a national basis. And we think that this is going to be sticky, obviously, because investment has become very fungible. It's much easier than people actually think it is to relocate manufacturing versus like a generation ago. And we have the tools and the latest technologies to do this. So I'm going to be, again, relatively optimistic here on the possibility of a so-called industrial renaissance and where it's going to happen. Final couple of words on climate really quickly. It's really crucial to bring that factor in when you're thinking about long-term investments in new, especially residential or any kind of development for that matter. You've got to look at the climate cost associated with it. So one of the things that we're doing is mapping out not just the climate risk of a place, but also the capacity to adapt to that risk and whether or not a place is still desirable. So you can see the left and right contrast here in the state of California, looking at, central areas. So the wildfire risk is very high here, but if you factor in the capacity of the location in terms of, say, fire response infrastructure and other capacity, you get a different kind of map. So we're doing this on a national scale so that insurers can calibrate premiums, but also so that investors can know what are the kinds of places that are going to be, again, more survivable and more cost-effective to remain in over time. So again, year on year, insurance premiums are rising drastically. So when you should always be factoring in what the prediction is around the annualized increase in insurance cost due to hurricanes, wildfires, or flooding, and build that into your cash flow modeling on an asset. It's going to affect, obviously, your OpEx, your CapEx, eventually your NPV and your valuation. So data like this, is absolutely crucial to decide where to invest in the future. So climate, plays a really key role. Just giving you here a screenshot, and we'll circulate this later, of the toolkit that we've built to enable that cash flow modeling by making a more realistic set of assumptions around the costs, the actual material costs associated with climate change, where we bring in these key factors like insurance, utilities, and so on. Again, we want to point to zones of opportunity. It doesn't mean large-scale relocation. It could simply mean that if you take an area that was hit by Hurricane Helene last year, but you look slightly further inland, you map out the locations that have higher resilience, meaning better infrastructure, strong socioeconomic characteristics, building permitting, affordability, and again, lower climate risk. It'll point you down at a zip code level, or even more granular, to the kinds of locations of opportunity as people relocate away from high risk areas. And of course, these slightly internal areas are still underpriced, right, relative to those coastal areas that have already increased substantially in value. So we see opportunities there. We reinforce that, I would say, by modeling migration flows, right? What are the places that are likely to gain in population because of that combination of job creation, kind of sticky economies, high climate resilience, lower insurance costs, and other kinds of factors. So in modeling this, we call this resilience-seeking behavior, or risk-avoiding behavior. So you can kind of take the entire country and look at how the inherent characteristics may make a place more attractive over time, and a lot of those places are still underpriced. So we find zones of opportunity even in high-risk states, as I showed you with Florida earlier, and then zones of opportunity in parts of North Carolina, Michigan, really all over the country. And you can look down at a fairly granular level within urban metro areas to kind of layer in everything that I was just showing you, everything from where is the greenfield investment, where are people moving, where is their climate resilience, where is the economy strong, and so forth. And that's going to give you a picture of the kind of markets that could be winning places in the future. So, we built these sort of hypothetical portfolios. Again, we'll circulate this. You can have a look, and happy to continue the conversation. But, what were the top performing markets and submarkets pre-COVID in terms of MSAs, in terms of their HPI growth rates? What are the places that did the best during COVID? What are the most fastest growing master plan community areas? What are the places with the highest climate resilience? And which places have the most new greenfield corporate activity? So taking a subset of our top winners from each of these categories allows you to kind of construct a whole portfolio of geographies that we think are going to be strong performers over the coming decades, or coming decade at least. We built a hypothetical portfolio around these, and we sort of have back tested it to show how it would have performed had you bought those locations going back starting in 2020. And it's actually outperformed the Case-Shiller and the HPI. So just kind of painting an arc there from the sort of tragedy of the present to how we could hopefully turn things around as a country, and how real estate can be an anchor of that if we think smartly about which real estate assets and geographies we take advantage of, and where we build for the future. So let me pause right there and hand it over to everyone. Thank you.
Thanks, Parag. And maybe at a later date, we'll do a full one on climate together. I know a lot of investors are saying, well, we don't worry about climate, but if one thing the LA fire showed to us is that we may not worry, but the insurance companies worry. And when the insurance companies worry, then we would need to worry. That's exactly what Warren Buffett said at a meeting a couple of years ago, that the moment there'd be a catastrophic loss, the insurance companies could really backtrack on some areas. So, but we'll get to the environmental maybe or the climate another time. But any thoughts as you finish your presentation on what you see on the capital flows? Because capital obviously is a big thing for investors in the U.S. Are foreign investors, especially from Asia, are they now pulling capital up based on what you're seeing currently, or are they still patient?
It's worrying. I mean, again, foreign of net annual FDI inflows into the United States any given year, a substantial percentage of that is real estate investment, right? Whether it's individual or retail or portfolio. So obviously one should worry about both of those categories in light of the current trend. So there could be a pullback there because of course, why would you buy something if you don't even know if you're going to be able to access it if you can't travel to America, right? It's fairly logical. So we shouldn't assume that stickiness. Then you also obviously have the second order effects if the large institutional investors are souring a bit or limiting their exposure to the PE side of the equation, then that some component of that obviously is the real estate piece as well. So you might see a diminution of the foreign investment inflow into U.S. real estate, and we're going to have to pick that up domestically.
Thanks, bro. We'll come back to you. But Sandy, how about you? Can you give us some thoughts based on what you heard from Parag and what also you see on the ground based on all the volatility going on?
Yeah, well, look, I'm following Parag's always a tough job, and so I had paid you a lot of money, so you wouldn't do this to me, but it's okay. This will affect your next listing. First of all, thanks for putting this on. I think you always have such an insightful, group of people on to put together for everybody, and this is a great, excluding me. This is a great group of people. I'll go to a little more micro and maybe midterm. I mean, obviously, we're dealing with a huge amount of uncertainty. And part of what we do as real estate investors is sort of price risk. That's what we do. And we price risk with people, our tenants who hopefully make long-term commitments to us, and we build buildings, and we hope those buildings have a long-term sustainable life, right? So anytime you have periods of uncertainty, it puts all that entire food chain sort of at risk. And I'm looking at what we went into the year with, and we went into the year with concerns about inflation, interest rates, which was already in trouble, and consumer confidence issues. Then we started the year here in California with the fires, and then federal policy, which included huge immigration crackdowns, which I think I'll come back to in a second, but have a big impact on our tenants. And then obviously tariffs that have a huge a role with our tenants. And the one thing that I'll say about shopping centers, and you saw it during COVID, and this is sort of COVID-like, in the how quickly all this has come on. I mean, you think about it. Donald Trump was inaugurated on January 20th, and we're only on April 15th, right? So things have happened very, very quickly. People look for things in uncertain times. They look for things that provide stability, and clearly at our shopping centers, you have restaurants that people like to go to and shopping experiences people like to do on the weekends or after work, and other things. And I think we're still seeing that people use shopping centers. And so many people don't even go to the office anymore. At least the places that we provide, and this group of people provide for people to gather, it has some stability. And again, going back to COVID, that was the experience we saw. People even would risk their health to get out there and visit our shopping center. I think there's a few trends that are really undermining our customers. So even though today our traffic counts are still very strong, and I'm still seeing a lot of visits, and we use a lot of data to see, including smart cameras and Placer and other things, to see how we're doing. Our traffic's holding up just fine, and we're still seeing a lot of consumer growth as far as the consumer coming to our centers and visiting. What I think is the underpinning that's concerning us is the rise in consumer debt, which has continued to rise, and the cost of servicing that because of interest rates. The consumer delinquencies, credit card delinquency, and what's happening with this dip in consumer confidence, which is just accelerated. So all I can say is what's happening exactly in our centers, and I'll just give some anecdotal thoughts of what we're looking at, and then perhaps some of the things we're doing. Like I said, consumer traffic steady. One of the interesting things we're seeing in some states, we're in 3 states primarily: California, Colorado, and Chicago. In certain places in California and certain places in Chicago, we're seeing so much of our consumer is Hispanic, that in our very dense Hispanic areas, we're seeing a certain reluctance for people to gather, especially in areas where we have first generation Hispanic, and we're starting to see some weakening in that visitor trend. And I think people are afraid. I think people are afraid of what's happening with immigration policy and what ICE is doing and being picked up and potentially deported. And you're seeing even when people make mistaken, acquisition of people and deporting them, we're not bringing them back, or we're fighting not to bring them back. And I think that's kind of impacting how a very strong component of our shopper base is being impacted. I think we're starting to see, it's early, but we're starting to see in certain categories sales weaken, or at least sales growth temper. Our retail delinquency last month was the first month that we have seen a significant dip in our non-credit retail being more delinquent paying the rent. And we're starting to see that. Whether that's how long that trend lasts or how that impacts us, that'll be interesting. Leasing, look, and I'll be interested to hear what others say. We've had a number of deals that have either been put on hold, slowed down, or or just people saying, yeah, we're gonna step back for a while because they don't know whether, as a tenant, how they're going to be impacted by tariffs. And there's a whole series of, a vast majority of tenants import in a big way. And unfortunately, the way the tariffs were rolled out, it wasn't like limited to like, okay, we're not going to, China's going to be expensive, but we're going to buy from Vietnam, right? This has been kind of global, and trying to figure out how to resource vendors has been very, very tricky. And I'm seeing that in a big way. Labor shortage. Again, we had a labor shortage before to service our customer. That's impacted. And then, look, I'll give you one example. I opened a big tenant, about 40,000 square feet in Chicago, a month ago. And I had the grand opening a couple of weeks ago. And, they were sourcing from China, Vietnam, the Asian countries, some Mexico. I mean, they don't even know where to buy anymore. And I'm talking to this tenant, and he's saying, how do I make stocking decisions? How do I buy things? So I think we got a lot of uncertainty we're dealing with that is impacting us in a big way. And I'll just close with this. I think that hopefully there'll be more clarity. Right now, it's just changing every single day. I think that puts us as a buyer of shopping centers somewhat at either an advantage because we have cash if people really need to say, hey, I want to get out of Dodge, or frankly on the sidelines until we sort of see how this thing settles down. And I think that's kind of my high level view at this point. And by the way, we haven't even talked about AI. Before climate change gets you, I think the AI robots will get you. But I also think there's a hell of an opportunity there for how we will be able to understand in a better way which centers are more susceptible to tariffs depending on where they settle out, and which ones are a little less impacted. What's locally grown, what's not, what's in zones that have better tariffs, which aren't. So I think using technology to help mitigate some of that is going to be helpful. In the meantime, we're just messaging like hell to our customers to let them know we're still here and we're still thinking about them. And we know these are difficult times, and we're a safe haven for them.
So Sandy, AI is the next one we're gonna do together. So
Yeah.
we'll do another call on that, but that would be a great one. In fact, before all this happened, that was one of our focuses going to be. Just to finish off, you talked about as a buyer. Let's say, has your opinion of value changed, over the past, let's say, month or so? Like, do you apply the same cap rate to the same deal that you would have seen 2 months ago, 3 months ago? And how do you see the debt market?
Yeah. Well, so yeah, obviously two integrated questions. One is that the only way I'd ever buy or sell anything is through the best broker in the world, Reza Tadali, and supported by his great team. But the answer, I think, is no. Cap rates have to shift, right? First, let's just talk on the debt market. Normally, in times of uncertainty, money flows into treasury bonds. Rates go down. Obviously that's what happened with COVID. This is a very unusual thing. We're having huge shocks to the system, and rates are going up, right? So, or if rates are going down, they go down for a day, and the next day they pop back up, right? So you're not really seeing a trend to lower rates. That may still occur, but clearly the investor's not driving down rates. So any idea that we could buy at that at sharply discounted rates is gone. If the uncertainty factor rises, then you have to get a higher premium for making a long-term investment in an asset, right? So, you can't say that the uncertainty index hasn't gone up dramatically since the end of last year, right? So yeah, we have to look at it. We have to say, how's this center going to be affected, and really, how's this impact our tenants, right? Because at the end of the day, I'm a recipient of a string of income that's coming off tenants who I believe will be there for the long term. And anytime you weaken that, you're putting the cash flow at risk, and therefore my underwriting has to change. So yeah, so I think that cap rates. Well, we were a benefactor for the first time in my life, or at least in the part of the life I can remember. Retail was the standout. We were in a place where, hey, positive leverage, we survived COVID, everything's going our way. Today, you say, well, yeah, but is there a new COVID, which is the kind of the tariff winter, and how does that go? And that may impact not only the consumer but the underlying vendor. So it causes us to be more deliberate about how we view that risk. And how permanent that risk is. Now, some of that risk is man-made, right? So we got to see how that plays out. It could be good news. There could be a pony in that pile of what. But we'll see how that plays out. But look, for the time being, it's a difficult time to make long-term investment decisions from our perspective. To the good, I think shopping centers are still the haven of people who want to have things that are familiar. When you give up on the world, the federal government, and even state government, local business and local environments, I think, still thrive as long as you provide them a value in being together.
Thanks, Andy. Alex, how about you? I know you said that you've done some studies on tariff and some impact, and you heard Parag and as well as Sandy. Let us know your thoughts.
Sure. Thanks for having me. What a great group to be part of. I want to start with two quotes from very, very famous philosophers. One is William Shakespeare, who said, "There's nothing new under the sun." And the other is the drummer Neil Peart from the band Rush, who famously said, "Even if you choose not to decide, you still have made a choice." And I think that's right where we are. So we're all sitting around trying to wrestle with really significant changes to global trade policy, which I think is what probably ups the level of uncertainty a bit beyond a typical capital markets type of issue. So what we've looked at is, hey, is there anything here that makes sense or that we can understand, knowing that the vast majority of it may be very difficult to understand? And the second piece we've looked at is, well, what should we do about it? So on the things that make sense front, I think one of the things we did learn last week is the bond market still has power and still matters. So that's like sort of an anchor to be able to cling to when everything else is so chaotic. And the other thing that we've looked at is, you would assume, as Sandy was mentioning, that in times of uncertainty, essential tenants and essential retail-oriented companies tend to do better. And that's what, in a very short term, the verdict of the stock market does show on a year-to-date basis. So if you look at the share prices of grocery companies, their base supermarkets, they're up year-to-date. CVS is up over 50%. Entertainment, electronics are down. So exactly the discretionary retailers should be down, quote unquote, in this environment. The essential retailers should be up. So that's a comforting pattern to at least be able to recognize. In terms of what we've studied, we've done a bunch of a regression analysis under the theory that tariffs are the new inflation and probably then some. But we do have a great data set of the stress tests of the last few years where we can look at all the units in our portfolio, and we have 142 centers, about 4,000 units, feed that all into a bunch of regressions. And what the regressions show is that a 3% increase in CPI increases base rent 1.5% roughly. And you can very easily prove out the logic change from sales to base rent to NOI. So I'm not scared of inflation, especially because in times of inflation, customers flock to essential and value-oriented retail. So we've always been sort of a when's the next shoe gonna drop type of company. So what we own are centers where over 70% of the rent comes from essential and value-oriented tenants. Like we're not going to be the sexiest fashion user, exactly because of times like this. Going back to the Shakespeare quote, because if you look at the long sweep of U.S. history, whenever you have a high share of foreign-born population, economic uncertainty, there's always a rise in populism, regardless of whether you're talking about the left or the right. And so while the global trade impacts of the last few weeks are concerning, it really shouldn't be surprising that there's a populist sort of stream kind of coursing through our national public dialogue. So with that in mind, we've tried to position our portfolio to be ready for it. Now, the other two things I'll mention are in terms of what to do about it. We are still buying. We did just buy a Whole Foods anchored center in suburban DC, but the reason we bought it was because we don't plan to own it for as long as a typical asset, to Sandy's comment, and we think we can grow rents very significantly, so we have a double-digit return, and therefore are being paid for the risk in a way that we wouldn't have been paid for during other times. So I think, all in all, as an American, I'm obviously concerned about the trade implications. As a real estate investor, I'm excited about trying to grow rent and then finding more acquisition opportunities. On quick note on the debt markets, we tend to be a little bit more conservatively leveraged, as I know Nick is as well. We've been closing debt deals with really tight spreads. We've got a couple of deals we've done lately, 125, 130 bips over the 10-year T. So I think there does seem to still be, strong appetite from life cos to lend on these types of assets.
I thought I was on mute. Alex, thanks so much for your update.
You're welcome.
One of the things you talked about acquisition, and in terms of looking for value, you guys bought a lot of core assets over the years.
Yes.
Would you be a core stabilized asset currently with, not big upside?
Well, if you mean by B, like, are we comfortable owning core assets? We are. So we've modeled out every unit of every shopping center we own, and we're very comfortable that the long-term NOI growth is there so that it makes sense as an investment. But in terms of new acquisitions today, because we did do so much core investing, that the recent deal we did, I think, is a good example where, if we're so we write checks when we buy centers ourselves, right? So if we're gonna write a check, we want to make sure we can get some level of premium that's more operations and cash flow oriented that we feel comfortable with as a margin of safety in today's environment.
Thanks, Alex. How about you, Nick? Please let us know your thoughts.
Sure. No, I really appreciate Sandy and Alex's comments as well as Parag. I always appreciate Parag's very large picture to help educate us just on the macro side of it. And so thank you for having me this afternoon. What's interesting is the last couple of weeks, without a doubt, has seen increased volatility across every aspect of our business. And I think human nature is in times of volatility to want to do something quickly. We're seeing the world change, something should change. And I think it's a blessing to be in the business we're in with long-term leases. The downside of long-term leases is, when business is really good, it does temper our upside. There's no question about that. And I think we've felt that the last couple of years of why can't we grow NOI even more when times are so good? And the reality is it takes time to turn the leases. But the inverse is true in times of volatility, that we have the blessing of long-term leases. And that's going to help cushion the reality of any sort of downturn that we may see coming in the future. And so for us, it really is about what we set in terms of the business plan in calm times, and being really comfortable that doing the exact same thing, whether times are good or bad, is a good business plan, which is locating in great demographics. And so as Parag pointed out, you got to be really thoughtful of what part of the country do you want to make your investments in, not for the short term, but for the mid and long term. How do you think about climate impact? We look at that, and we look at that in comparison to our shopping centers. How do we think about the tenant mix? And as Alex pointed out and Sandy pointed out, we're blessed, three of us at least, to be in an environment where even in downturns, grocery does well, daily needs do well. And so we really step back and go, okay, even with all the volatility, we're not day traders. And so the good news is we can stay the course. We can stay waking up every day, pulling the same levers and pushing in the same direction, except for, I would say, in one aspect, capital allocation. And so there's no doubt when your cost of capital changes, you need to stop and go, what impact does that have on future business decisions? As Alex pointed out and Sandy pointed out, there's been volatility in the Treasury. Credit spreads over the last week have gapped. And so most people sitting here today, cost of debt is more expensive today than 2 weeks ago. And so they do need to take that into account in terms of capital allocation. And so I do think it will be interesting as we look forward to see what the impact to cap rates is. I think we would all said 3 years ago, cap rates would have gone higher than they did as interest rates rise. The reality is capital flows came into retail for reasons we know. Demand supply balances seems to be in really good place. And so it's going to be interesting to see do capital flows now continue to push into grocery anchored shopping centers, knowing they are a safe haven, safer than many other bets, if there is volatility in terms of the consumer. And so that part to me is going to be interesting to see how much equity can continue to push against the debt cost when we look at cap rates going forward. And I think each of us just need to look at our own cost of capital and make the best decisions based on that cost. And so I think it's a really interesting time to, as Alex said, do nothing, which is a choice, and be a little patient. And I do think that could be an impact that we all may start to see is those that have the choice to be a little more patient right now, I do think will be. And that could delay some decision making downstream. And that's usually not good for business over an extended period of time. But again, too early to tell if there's any impact yet.
Yeah, Nick, one of my favorite quotes from Buffett is Wall Street, money goes from impatient to patient in the long run. So,
great quote. Agreed.
Thanks so much, Nick. John, you're always very insightful about what's happening in New York and Wall Street and DC. Really appreciate your last minute joining us on this call. Would love to get your insights on what you're seeing.
My pleasure. Thanks for having me. And don't hold against me that I work on Wall Street. I know that's probably a bad thing these days, but just joking. Also, I want to thank Alex for quoting Rush, one of my all-time favorite bands. So appreciate that. Look, we've heard the word uncertainty a lot here. And when you have companies the size of Delta Airlines and Walmart, basically going like this, I think that it sort of speaks volumes. And, whether it's hearing from companies, whether it's hearing from our investors, it's a lot of, we don't know, so we're going to sit on our hands. And, we've heard a bunch of the panelists talk about committing capital. And I'll give you a real-time example. And this meeting occurred before Liberation Day. I was meeting with a developer who's involved in a multi-billion-dollar development in the western portion of the United States. And, we went through all the questions on interest rates and tariffs and so forth. And the short answer is we can't price anything. We can't move forward. I just finished a report on the housing market, which I'm hoping we'll publish today. And I went through all the potential impacts on tariffs. And when I went back and read what I wrote, I said, well, we don't know. I mean, here are all these different scenario analyses. And I think this is what is causing a lot of people to seize up. And just in the last week, I've probably been on 5 different commercial real estate broker calls across a variety of asset classes, with the exception of office in Manhattan, where leasing in trophy buildings is still going pretty well. I mean, not surprisingly, you're seeing industrial leasing has slowed down dramatically, particularly in coastal oriented markets. I'm sitting here in a panel of retail experts, so I don't want to step on their toes, but clearly there's been, some concerns there. We've seen, some pickup in bankruptcies, and I think it was Parag who talked about this, or maybe it was Sandy, I can't remember, the uncertainty of what things are going to cost. It's not just the end consumer anymore, the supplier, because the supplier is the one who is going to be paying this, and whether they can move it, whether they can pass it along or not, is a real question mark. I was really, really taken by just looking at the latest University of Michigan consumer data. And if you break it down into its components, some of the moves were stunning. Now, I understand that, surveys are surveys and they're not hard data and the sample size is not large. But if you look at the consumer expectations for the growth in inflation, the decline in incomes, the expectations for a rise in unemployment, the fall off in consumer confidence, the outlook for business conditions over the next 12 months, it has been nothing short of stunning in my view. And one of the good things about not being an economist, and I do not play one on TV either, is that sometimes we can look at things differently than economists do. And I was down in Atlanta a couple of weeks ago in a meeting with a bunch of real estate and hard asset investors, and the question came up about, do you anticipate a recession? And again, this was before. This was before Liberation Day. So I asked the question, how are you defining a recession? Are you defining it as traditional, the way economists would, two quarters in a row of negative GDP, or what I call a functional recession? And what I mean by a functional recession is, are people acting as if we're going there and it becomes an ultimate self-fulfilling prophecy? So when I saw this University of Michigan consumer data the other day, I was like, oh my Lord. And now, again, we're all emotional creatures by habit, and we tend to react. And in this never-ending news flow cycle, especially with a president who I think spends more time on his phone and Truth Social than he does anything else, we're barraged with I won't call it information. We're barraged with certainly a lot of talk and a lot of uncertainty. So I think look, the good news here is that unlike the global financial crisis, while spreads have gapped out, as Nick talked about, they're still below where they were during more stressful times. Liquidity has not dried up. Now, that said, we don't have the Fed throwing liquidity at the market, and I suspect, could they cut rates? Certainly UBS believes the Fed will reduce Fed funds rate, but it obviously is going to be largely dependent on what goes on in the employment market. So we'll have to see. But one of the things that as analysts we always worry about is, what don't we know? And I'm going to go back to long-term capital, and I'm sure there are a lot of people on this call who remember long-term capital. They were the smartest people in the room. I studied under some of them, but the smartest people in the room can make mistakes. And one of their great mistakes was saying we'll never have a 10 standard deviation event. Now, this is not to criticize them, it's just a reality. But what we didn't know was, because they spread their trades all across the street, well, everybody said these are the smartest folks in the room, we're going to piggyback on their trades. And we saw the aftermath of that. And so what you don't know is what is lurking that could really upset liquidity. And I don't want to be Debbie Downer here, but one of our jobs as analysts and strategists is to think about all these scenarios. And so I know when we've seen treasury yields bouncing around the way they have, there's been a lot of talk, are foreigners selling bonds? Is it an unwinding of the basis trade? I think there's a lot of things behind it, but that's one of the things I always worry about, is what liquidity events don't we know about yet? And so I think it's something we just need to pay attention to. I think our net takeaway is that we have a president here in the United States who is very mercurial, to be charitable, and can undo this with the wave of a hand. He is a very unique individual, and handicapping what he may or may not do, I think, would be a fool's errand. So I think the word of the day, and we've heard it a lot in various forms, is caution. I think committing of capital, whether it's to data centers and hundreds of billions of dollars, or it's to people sticking their necks out to make smaller investments, I think they're probably likely to pull back on that. And I think Parag addressed this in terms of foreign capital coming in to buy U.S. assets, particularly real estate assets. One of the things that I've always said is that I think there are three major reasons foreign capital comes to the U.S. And I'm going to do it in reverse order, the way I normally do it. We have the deepest capital markets in the world. We have the best property laws in the world, and we have the most stable politics in the world. Number three, I think, is a little more challenging these days. And, a lot of people have referenced, if I come to the country, can I get out? And, so we're looking, you can look at, enplanement data, or you can look at visitors to Las Vegas. I mean, this is all sort of high frequency, but, very specific data. There's clearly a downtrend. Travel into Maine from Canada, hotel bookings. These are all things that we're looking at. And look, we all hate uncertainty. And look, if you want to guarantee, no pun intended by treasury bills, but this level of uncertainty, I think, is not going to be your run-of-the-mill level of uncertainty, just because of the global nature and how disparate the impacts are. So I think all else being equal, at the risk of overusing this word, caution is the operative phrase that I would use right now.
Hey, Reza, do you mind if I ask Jonathan and Parag a question?
Please, you guys make this as interactive as possible.
Okay, cool. So I have a question for both of you guys. I was talking to a foreign investor the other day who, to my surprise, actually had some concerns about it was a non-zero probability in his mind that the current administration would impose capital controls on foreign investment. I'm just curious, in any of the scenarios that the two of you guys look at, would such a sort of seemingly laughable, far-fetched scenario, ever make it onto your radar screen, or do you see that as a zero probability event?
You want to take that first, Parag?
Very briefly, probably zero probability, because I just can't imagine the private sector, the financial actors implementing it. And it's even just to design it, to structure it, isn't something that can just be done via executive order, it seems to me. I mean, of course, this is not a president who seems to obey the separation of powers all that clearly, but this is sort of something that, you would need. It would need legislative support. I can't imagine a proposal like that actually seeing the light of day. So not necessarily, no.
Yeah, and Alex, what I would say is, with this president, I'd hesitate to say anything is a zero probability. But first of all, I think, Parag, I absolutely agree with him that it would have to be legislative. But, just looking at, and we can debate the merits of the EB-5 program, but this gold card, I think, really shows that they want to have capital from outside the U.S. invested in the U.S. And so while one never knows, I think it's a low probability they would do that.
Just along similar lines, I'm curious both of your perspective on just where you think the capital will flow now. I mean, when you force rank the U.S. now, as you just talked about, John, what you used to say was the benefits. When you look across the world now, Parag and John, where does that flow go? I mean, most of these other countries are having similar, if not bigger, issues related to those three categories you just outlined.
Just quickly, I wouldn't be overly optimistic about Europe per se, but as you can imagine, relative to what the mood was earlier, the fact that external shocks have provided them with a certain momentum and motivation to consolidate, to invest more inward. And so in Europe, everything that they've wanted to do and haven't done around capital markets union, banking union, industrial policy, green energy policy, they're calling it a Euro stack now, their own sovereign cloud architecture. All of these things are gaining currency, to say nothing of strategic autonomy and defense tech and so forth. So Europe, I think, is, in some ways a beneficiary of this. In general, the trend towards inward investment, right? Not just recycling your capital into our, liquid American capital markets, but just seeing what mileage you can get and kind of writing your own history, right? Creating your own story, being a driver of your own growth with that capital, even if it's not going to return what the U.S. return profile has been. So places that have the capacity to do that. What you're hearing in China, obviously, is that now one of the measures that they're going to take is most certainly around driving consumption growth, which they have, been suppressing obviously all this time. So you could see them, channeling their resources in an inward way. Is really about a wealth transfer in many ways. But so those are the principal regions that benefit. But then just really quickly on supply chains, you're already hearing, of course, about, Apple will soon be making one out of every 5 iPhones in India. It wants to do more in Vietnam. They could nearshore just a little bit. So geographies that are going to capture that, relocation of foreign investment are obviously going to be winners, and Southeast Asia is probably principal among them because Vietnam already caved and went to zero tariff with the U.S., which actually explains also why Xi Jinping was in Vietnam today and yesterday signing 40 new trade agreements, because it's just going to accelerate the Chinese capital or FDI flow into Vietnam. And then if Vietnam still gets punished somehow, then it'll go to the Philippines. The Philippines is a friendlier U.S. ally, so we're not likely to put tariffs on them. And so then China will relocate investment there. So, supply chains always find a way.
Yeah, and what I would just add to that, I tend to think of it from a property type perspective. So I agree on Europe, and I think Europe has one of the challenges we do in the U.S. and Europe is obviously a very large area. It's affordable housing, which is why I think the rental housing market will be a very interesting investment asset class. Obviously, we want to watch certain countries like Germany and rent control, but let me leave that one aside. And Parag mentioned the other one, which is supply chain. And one of the things that I thought about this, especially when COVID happened, was we've spent over the course of my almost 41 years doing this, outsourcing everything first to Mexico and then to China. And what we learned when COVID hit was single sourcing to effectively one country, especially one where we have such a complex relationship with, was probably suboptimal. And so I absolutely agree with Parag that we're going to see multi-shoring here, and that's going to be great for the logistics and warehousing market. Plus, I'm still a big believer in e-commerce. Not at the expense of brick and mortar retail. I think the whole omni-channel, I can't. I'm sorry, I'm having a little trouble today. The whole omni-channel is in place. I'm sorry, I've been up since 3 o'clock in the morning. I apologize. And the last thing I would say is the triple net lease market. And you've seen a couple of the large US REITs move into the triple net lease market in a fairly sizable way in Europe. And it's a combination of, it's much more capital efficient for companies to offload their real estate. It's a high cost, number one. Number two, the cost of funding in Europe relative to the US is relatively attractive. So that's another area that I would highlight as well.
So, Parag, you heard, or on the investor side, audience is primarily real estate investors in the US. And given all given all that's happening in Asia and with the tariff wars and the capital flows and all that, what advice do you have for the investors? Primarily, our investors are retail investors, shopping center investors. What are advice for the US-based investor?
Yeah, let me synthesize a little bit, to reinforce some of the most important points that I've heard in this conversation, which is, pick those markets that already are strong, stabilized, and growing, where you can ride the other data streams that we've talked about, specifically where you're seeing new corporate greenfield investment or rising investment, where you're seeing, building permitting data be constructive, where you're seeing migration flows and demand, where you see affordability. Those particular data sets and a few others are really going to reinforce your conviction around high growth, high potential markets. So for now, you would want to stick there, and as the economic conditions stabilize and hopefully recover, then you may start to spread out into some of the kind of emerging growth areas that I've started to point to based upon some of those trends that are more at the 3 to 5+ year horizon.
Thanks, Brian. How about you, Sandy? What's your advice for the group? And how do you approach the next few months dealing with the uncertainty as an investor and as a business owner?
Well, look, from my perspective, I think there's a couple of things. One, and I think Alex touched on this. I think if you have cash and you're patient and you're an operator, I think you have a good view of opportunity, right? And in times of transition, and that implied to right after 9/11, this applies to the financial crisis, that applied to COVID. There's always opportunities to do two things in my view. Look for people who need capital because they over leveraged, or they anticipated that rates were going to go down and have a debt issue, or There's some other reason that you can invest because you have the capital to do it. But the second thing is to double down on the centers you already own and the properties you already own, and reinforce your role in every community. And since everyone was quoting, my favorite lyrics are from Detroit Kiss from Detroit Rock City, and the tendency of people to really want to dress up on Saturday night and really wanting to go rock. I think that people are still going to be shoppers no matter what happens. Now, where they shop and how much they shop, I think they'll limit where they're going to go to less and less places, but the value of those places will go up because they've made themselves more desirable in a place where people feel like they get a better value for their time spent. It's value on money and value on time spent. So I think it values. I mean, certainly for how Alex operates, Nick operates. We're operators, right? We run these centers. We are a part of the community, and we can adapt as a community adapts. And I think that's the way we look at it. The question that's gonna be interesting is whether this conversation about tariffs is going on in a year from now or not, right? And when like Parag said, China has been preparing for this, and I guess my question to Parag would be how they've been preparing and who has the balance of power here. Do they need us as a consumer more than we need them as a supplier? And is it likely that this China, we've been talking about it a long time, but is it likely that Trump calls a win at some point and brings us to it sooner than not? Because it's not actually the tariffs that are the problem so much as it's the uncertainty of how long these tariffs will last or where they apply to or anything else. As business people, I think the rules, once you know what the rules are, you can adapt to the rules. Yeah. But when the rules change, it's very difficult to make long-term decisions. We're in a long-term business. So Parag, I'd be curious about what your view is. And because when you said they've been preparing, I'm interested in what you mean by that.
And they've been helped or enabled, let's put it that way. You may have heard that Apple flew like 60 tons of iPhones, or I don't know, 5 plane loads of iPhones directly in on, chartered planes from China in anticipation. That's just one example. That's post-Liberation Day. Pre-Liberation Day, even when you have an announcement of tariffs, you have everyone front-running the tariffs and increasing their stockpiles in order to obviously come in before the tariff imposition and so forth. So that's what winds up widening the trade deficit. So that's the small items. But in terms of the resiliency of China, let's be clear, whether you measure it as a share of Chinese GDP that's dependent on exports of the United States, or the percentage of total exports from China that wind up in the United States, you can have, first of all, it's not a complete blockade, right? Or actually, I mean, the only blockade that's happening is China saying that it's going to ban the export of rare earth minerals to the United States, and them actually saying that they will no longer buy Boeing aircraft, right? So, they're definitely inflicting some pretty severe direct pain already on both ends of the spectrum there. But they can substitute. So a lot of their exports will still come into the United States despite the tariffs because they're just crucial. So importers are going to pay that and pass that cost on, whatever the case may be. There's certain just non-substitutable imports from China. At the same time, they will continue to redirect, right? So they'll redirect through, again, these third countries that have lower tariff measures imposed on them and still get their goods in the United States. You'll also have a redirection, right? This is the overcapacity problem that not only the U.S. but others, have worried about. But China is going to find other markets, to absorb their goods. Already, you've had Europe almost crazily, according to the commentary and analysis, Europe saying they're going to actually liberalize trade further with China, which means that they're going to actually wind up buying more Chinese electric cars and putting, digging their own automotive industry a deeper grave. So there's lots of, perverse global substitution effects that are going to happen. So bottom line is Chinese corporates can absorb the pain of lower exports. They'll boost domestic consumption, which I was referring to earlier. So they'll absorb some of their own. They'll slow down a little bit. I mean, they have a whole bunch of policy instruments at their disposal that they're going to implement really, really quickly. So I honestly don't worry about their fundamental stability in this situation. I really don't.
John, I had a question. I think I saw a report. What's Wall Street saying about which REITs or which public companies have the best, either the least exposure from this period of time, or have the most exposure?
Well, without a doubt, I think the most exposure would be the industrial warehouse REITs, and you've seen it. I mean, other than the office REITs, which, because they were one of the strongest performers last year, have actually underperformed this year pretty substantially. The ones that have fallen off the hardest since Liberation Day or leading up to Liberation Day have been the industrial REITs, particularly those with larger coastal exposure. And you see estimates being cut across the board on the street. Sell side is downgrading the names. I think, when you look at it, what is more insulated, triple net, particularly ones that don't have a lot of exposure to some of the more troubled retailers that have filed BK. The healthcare REITs, particularly senior housing and multifamily, or I should say rental housing. And I know a lot of people are concerned about the impact of what if we have a recession, and we can look back to prior recessions on what happened to rents. But I think the flip side to it is that multifamily had been really the victim of a lot of overbuilding over the last several years. That new supply is coming down. And so, what we're hearing is that with uncertainty in tariff costs and uncertainty in the economic outlook, that new supply could fall even further. So I think, I still believe at the end of the day, people need a place to live. The housing market, even with a pullback from peak prices, housing, whether there's a lot of ways to look at affordability. Housing is extremely unaffordable, and then you layer on consumer confidence. So I think the rental housing market, being single or multifamily, will hold up very well. Office is going to be largely tied to what leaving aside all the other challenges of office, what happens to employment. And so I think, you stay, once you get away from these trophy assets, I think it's going to be a more challenging place. And then I think that, there's a big debate on the shopping centers. On one hand, people are concerned about, what's going to happen with more bankruptcies, what's going to happen to the consumer. The flip side is it's the whole flight to safety argument. And I think, I'm seeing, both sides of that argument there. So those are the sort of major property types. The one that I think is getting a lot of debate is self-storage. Because look, housing turnover activity has been pretty weak. I think it's going to get weaker. We've already we'll hear from D.R. Horton, I think later this week or early next week. We've already heard from Lennar and KB Home. These were not upbeat calls to be charitable. And there's a fairly high degree of correlation, not perfect, but fairly high degree between housing turnover activity and self-storage demand. So I think that's been the most highly debated. And just one thing, Sandy, at the risk of dating myself, since you mentioned Detroit Rock City, I saw Kiss in 1977, and they opened with Detroit Rock City on the Destroyer tour.
Yeah, well, that's good. I was probably rocking in on the West Coast there with you. Yeah.
Hey guys, can I want to chime in with one other sort of twist on this, if that's cool. A lot of this conversation is assuming that individuals are kind of rational utility maximizers, and that will drive a consumption behavior in the United States. And while I think there's a lot of truth to that, especially for those of us who own shopping centers in affluent and highly educated areas, this also has to do with feelings, and not just feelings about, oh gosh, what's happening with my 401k, but deeper, longer term feelings in the United States. And for anybody who hasn't read the Atlantic article called The Antisocial Century, I would highly recommend it. It's a great, quick, efficient clearinghouse, but the punchline is Americans are very lonely. And Americans aren't just lonely now. They've been getting progressively lonelier over the last 30 years. And there's a ton of data that supports it. And I know Sandy's very much on this train with all of his great events and marketing that he does. But just a couple quick, interesting stats. People spent more time alone after COVID than at the height of COVID. So just that's a crazy thing to think about. The other interesting piece is that since people are now, shopping, working, worshiping, et cetera, at home, yes, it's efficient, but the self-reported happiness from all of those tasks being done at home is much lower than being done not at home. So as we think about owning and operating shopping centers in a world where people don't know how much things are going to cost, if the suppliers can even get the stuff in the first place, it really reminds me of some of the calls we had at the beginning of COVID. I'm sure Sandy and Rez will remember this. Like, people were saying, like, dude, I cannot get the boat. I cannot get the boat from China to Long Beach or wherever. I just can't get the boat to go, right? And so I think we're all well served as investors and operators to like remember some of the other longer term societal trends that are exogenous to today's kind of fire of the moment. And those trends aren't going anywhere. And they're highly correlated, in my opinion, with some of the political dynamics we're seeing out there.
And to that point, first of all, Alex, you always give us the best things to read, and I always feel so dumb saying, if I told you the books I read, I think I would never be invited back. But that's the point of, I think, of what we can do. We're not victims here. The trends are very, very strong. We're hunter gatherers, and we like to go there. I think the key, though, is people do have a choice where they go. And where they go is somewhat defined and in our hands by how we reach out to them, how we connect with them, and making sure our retailers get it and we have the right mix of retailers and we communicate with them. So I think there's a lot of goodness here in what can be achieved, but I think it also impacts the product choice of what we buy and what we invest in and what we build. Not that I anticipate there'll be a lot of building with especially in LA with increased labor costs and everything else, but I just think if we provide great environments for people to come, our tenants will do better, our rents will grow disproportionately, and this period of uncertainty could just reinforce our connection between people and our shopping environments.
Thanks, Andy. How about you, Nick? What are your thoughts for advice for investors as we're facing what's ahead over the next couple of months with the uncertainty?
No, I'm gonna add on to Alex's comment. I thought it was really insightful. I think that's the beautiful thing of the business that most of us on this call chose to be in terms of retail real estate, is we really are at the crossroads of we can deliver goods and services really efficient and effectively. And that's not going to change tomorrow. And so we are still a really effective way to give people what they want to buy and what they want to eat and what services they want to have. And to Alex's other point, we also have the opportunity, and I think as long as we continue to lean into it, we're going to see the fruits of that labor and that effort of creating an environment people want to hang out with their friends. And so I was just at a grand opening. I was thinking as Alex was talking, we just opened a gourmet hypermarket grocer in the San Francisco market at our mall, Serramonte, a couple of weeks ago. And there were, I'm not exaggerating, at least several hundred people waiting in line for the grand opening. And that continued throughout the entire weekend. They were at max capacity through the entire weekend, had 45,000 visitors over the weekend just to experience that store and celebrate food and celebrate the Korean culture that store is bringing to the US in a different way than has ever been done before. And so despite all of the macro headwinds, despite all of the volatility we're having over the last several weeks, I still just look forward and look mid and long term and go, people are going to wake up and they're going to want to buy stuff. And they're going to visit with friends and they're going to want to be entertained. And we have the opportunity to continue to provide that. And in an environment where there's not a lot of supply coming online, we're one of the largest developers. We're still bullish on it. But even with what we're able to build, there's not a massive amount of supply coming online. And so I still think short term, I can't predict anything, but mid and long term, I feel really, really good about at least what Regency and others on this call are waking up and doing every day to create a commerce within the US in a positive way.
I was listening to a talk by Steve Eisman. He's the famous Big Short guy in the movie. He was talking over the weekend, and his view is that everyone is panicking too much, and he's very bullish on U.S. in terms of reshoring. So it was an interesting take. And for some of you who are interested, feel free email me, and I'll send you a link, or you can look it up on YouTube. How about you, John? What about you?
Yeah,
Well,
and what I always like to say is that there's no right and there's no wrong. There's only what's right for each individual investors or client's situation. In fact, while I was on this call, one of our advisors reached out to me and said, "What do you like in your space now?" And I wrote back, and the two questions I asked were, "What's your time horizon and what's your volatility tolerance?" And we all talk about, oh, we're okay with the risk and we're okay with volatility until we see it. And we've seen volatility in spades over the last several weeks. And so I think it's really important when we have our conversations with clients is to understand their risk tolerances, their volatility tolerances, their liquidity, near-term, mid-term, and long-term liquidity needs. And so in the seat that I sit in, where I work with our high net worth investors around the globe, is these are the questions we ask. And so in this case, this particular question I was asked, they said it's a multi-year time horizon and we can handle a fair amount of volatility. That made it much easier for me to say, here are the names that I would recommend to you. But it's really important to, I think, I always say nobody knows you better than you. And I say this, whether it's young people I'm talking to want to get in the business or I talk to clients. And so if we can get really to the heart of what their hot button issues are and how much they can tolerate, that's going to drive, our specific advice to them. I mean, this is public knowledge. We recently upgraded U.S. equities to attractive from neutral after, whether you want to call it the president blinked or what have you. And so the view was from our equity strategist that some of the risks have been taken out of the equation. But, and I absolutely agree with that statement. But, nonetheless, I think when we're talking to each individual investor, from the least sophisticated, the incredibly most sophisticated, these are the things we still want to get at to understand really sort of where their pressure points are.
Great. Thanks, John. So, we have 5 minutes left. Just wanted to go around and just any parting thoughts, final thoughts, and I'll start with Parag.
Well, I mean, I've learned a lot from this conversation for sure. I think it's a more nuanced picture than people are maybe have came in with, and what we're hearing in the mainstream. I would close on this. It's not a good, yes, on the one hand, people will say, well, this is the time to sit on the sidelines and wait, buy the dip, wait for the crash, whatever. At the same time, when you think about things from the cultural perspective, from the national perspective, and you see these global trends around bifurcation, it's kind of a time where you have to buy American, right? Not because you support the administration or don't support the administration, but, with withholding capital from where it's needed right now in the market, in society, whether it's at the micro level of keeping the economy, sort of going and pulling out of recession or preventing recession, to the broader picture around stimulating this, again, whether you want to call it the new renaissance, new industrial renaissance, and building the future supply that we need of the appropriate housing stock and other stock of assets. That money you can't guarantee that that's just going to come from others, not from us, right? So, we have to balance the traditional market behavior, which is of course fairly, short-term and, rational. We're following certain patterns versus the kind of systemic needs of the country at this point in time. And those needs have been around for a while and have been building up and pent up. And it's not going to be a pretty picture, over the next 3, 5, 7 years if Americans don't invest in America itself. So, I urge people to, despite the risks that we can all point to right now, to find those opportunities.
Thanks, Parag. How about you, Nick? Any parting thoughts?
I'm not going to follow that. I agree. I mean, I do think there's going to be opportunities here, and I think the more we can focus on mid and long term, the better you can feel about, waking up every day and doing what you do, because I believe the U.S. consumer is going to spend more long term than they are today. It may be a bumpy road there, and I agree with Parag. I think right now people are rolling up their sleeves to figure out how to maybe manufacture, buy, build in the U.S. in a different way than they did before, and that could lead to some green shoots that we can't see right now. So it's not to say it's going to be all fun, but I can still be optimistic.
Thanks, Nick. How about you, Sandy?
Yeah, I mean, look, I think it's very hard. Most of the time we do a really bad job of forecasting the future. And I think sometimes we overcomplicate ourselves. I think right now sticking to our knitting. Not being we either over worry or under worry. We never quite figure out what's the right part to worry. So truthfully, our view is we like what we do. We like what we are. We think we're decent at it. We're going to stick with it. And look, I believe in the United States. I believe in the United States geography. I believe in the long run it figures itself out. We're having these swings, but I think we'll find center. I still think we're the best place to make investment for the long term.
Sandy, what you said about worry, one of my favorite quotes from Bill Miller, who's a big value investor. He says, "When everyone is worried about something, I don't worry about it."
Let everyone else worry. Yeah, like I said, I get the ulcer, so you don't have to.
How about you, Alex?
I think as an investor, it's an exciting time because uncertainty should lead to more of a return for operations and less capital allocation. So that's good for a platform like ours. I think maybe more importantly, as an American, and we're all blessed to have had some level of success to participate in this call. If there's any way that what we can all do is to support civil society, whether it's churches, universities, community organizations. Those are the fabric of what makes our country a very special place to be. And we all have been blessed, right? So we all have certain responsibilities.
Thanks, guys. I always admire your thoughtfulness. How about you, John? Any thoughts?
Well, I'm going to pale after what Alex just said, but I would say two things. Don't invest your politics and don't invest by the rule of one, i.e. what you think. I think back to when I started in the business. I actually started as an investment banker. There were obviously no cell phones. We just got desktop computers. There was no internet. We had FedEx. And now there's instantaneous access and again, whether it's useful information or not, and we get so wrapped up in what's the latest thing we read, and we by nature self-select, and that skews our judgment. And one of the things I love about what I do is I don't have the luxury of bringing my own view or letting my own views cloud my judgment. I'm a human being and I accept that, but that's why I say don't invest by the rule of one. And so I would say those two things. And the last thing I would say is, yeah, there's always something to worry about. And, Sandy talked about worry. I get paid to worry for a living. But when my 28-year-old daughter the other day said to me, "I'm really worried we're going to have a depression in this country," I said to her, you have a very, very long time horizon. Don't worry. Leave the worrying to me. That's what I get paid to do.
Thanks, John. Personally, I would say one of the things that I really took away last year from Berkshire Hathaway's meeting from Buffett was resilience. He was very emphasizing on resilience. And he said, never depend on the kindness of strangers. And so that was one of the things that really stuck in my mind. And I was in a recent meeting with a very good friend and a client that he said he had 7 refinances recently on commercial properties. And on 7 of them, he had to bring in additional cash to refi. So given the market, I would highly recommend really pay attention to resilience and then opportunity. I've never seen great opportunities come when everything's certain, and biggest opportunities come when there's a lot of uncertainty. So uncertainty is our friend. So those are some thoughts. But thank you all. Parag, thanks so much. I know it's past midnight for you, and
No worries.
appreciate it. And everyone, thank you so much for participating on this panel, and the audience, thank you so much, and best wishes to all.
Thank you, guys.
Reza.
Great seeing you. Thanks, Reza, for putting this on. Take care.
Thanks, Reza.